these last few days. So no PowerPoints. It'll be just me talking, and I'll try and make it as interesting as possible. So I work at Backed. Backed is Swiss startup. We tokenize real-world assets, or some people prefer to say off-chain assets, whatever you prefer. And we focus on listed, publicly listed securities. So blue chip assets like the S&P 500, US Treasury bills or bonds, anything that basically is popular and useful in the real world or off-chain world, we're aiming to bring on-chain because we think they should be useful as well on-chain. Today I just want to first start by giving maybe a high-level overview of real-world assets in crypto. RWAs have been like the subject of discussions for a while now, and it may seem to a lot of you pretty disappointing. I remember in 2017 how everybody was talking about, tokenizing the world from wine to real estate to shares, and nothing really material happens. So it's been a bit disappointing on that front, but to be honest, it's pretty normal. Like things usually happen in steps, logical steps, and yeah, so we think wine or, I don't know, whiskey, it will happen, but probably further down the line. However, real-world assets are already, and they've already been in crypto for a while, and they've been successful. And the best example is stablecoins. Stablecoins are the first off-chain asset, real-world asset that's been tokenized and has been super successful. First one was USDT. Now, followed closely by USDC. And then there's been a few attempts like Synthetics or Mirror, FTX. I'm not gonna dwell too much on what happened there, but yeah, there's been already like some decent experiments and definitely like successes there. Long term, yeah, we definitely believe that crypto, leads to more efficient trading and more efficient settlement. I think that's why we're all here. But this is very much like for the long term. It won't happen today, unfortunately. But we can definitely see it on the horizon. For now, what we think will happen, and the problem that we are trying to solve is an accessibility problem. So we're trying to bring those off-chain assets first to crypto natives. You can think of, MakerDAO. They've been leading the charge there. They now hold about 600 million of US Treasury bills and bonds in the forms of ETFs. And we've just actually tokenized those two ETFs that they hold. But yeah, so bringing those off-chain assets to crypto institutions like Maker and smaller ones, to high net worth individuals in crypto that, for example, got a bit scared with USDC. When you're holding USDC, you got some counterparty risk, whereas when you're holding book entry securities, essentially you mitigate that risk or you kind of remove it. So yeah, short term, bringing those assets to crypto natives. It's slightly further down the line, it's about like bringing as well those popular assets, S&P 500, US Treasury bills and bonds to the underbanked people in South America, Africa, Southeast Asia, where for them it's, for some populations, it's actually easier to buy a Tesla car than it is to buy a Tesla stock. Yeah, and the way we approached things was to, I mean, we've tried to solve what we call the trilemma by bringing assets that are like first safe, i.e. like we back them by the actual underlying, that they're compliant. We're based in Switzerland, leveraging the DLT Act. The Swiss have been very innovative in their legislation. And also filed a prospectus in Liechtenstein to again make these tokens retail grade security tokens. And the third I'd say attribute that's been really missing with in the previous attempts from other projects is that the tokens are freely transferable. We think that's what really matters. If there's no point tokenizing, I don't know, U.S. Treasury bills or bonds if they are limited to being to live in a closed garden. Like, what's the point? Why would the same guys that are able to access that closed garden are also able to access, like, to be banked? Why would they get exposure on U.S. Treasury bonds via closed garden, crypto closed garden, when they can just like do it with their bank? So yeah, real full transferability is super important. Assets that we actually tokenize, like the tokens themselves, they're plain ERC20 tokens. Again, the idea was to leverage everything that's been built already in crypto and DeFi. Yeah, so what does it mean? What does it mean for crypto? What's the potential there? When you look at crypto right now, it's $1 trillion industry. Like the global public equities market is 100 trillion. So it's got the potential to like grow DeFi and crypto by a factor of 100x. That's what we think. Then you can use those tokens in DeFi in general, whether it's to trade them 24/7, lend them, do all sorts of degen stuff that's been done with utility tokens. It also matters to like the traditional financial markets, and it will mean that price discovery would happen on crypto during off-market hours. So I don't see a reason why in a not so distant future the Nasdaq traders will actually look at crypto secondary markets to actually gauge where securities like Tesla share or the S&P 500 or US Treasury bills should open, which is pretty cool. And it also means like a whole new market available, new population, whether it's like crypto natives or again underbanked population. So I think there's great stuff to there's a great future and great benefits for both like crypto and traditional finance. If you have any questions, feel free. Otherwise, enjoy the rest of your day. But yeah, go ahead. Sorry. Yeah. So I'll try and speak, from our position. Whenever like we issue or redeem tokens, we have to do AML on these tokens. And so if they go through Tornado Cash, that will raise the risk quite significantly. We'll also have to enforce like OFAC sanction addresses. So it could be possible that, on secondary markets, they end up, trading. But definitely on the primary markets, that's going to be more complex. Please. Can you buy them? Yeah, they're available on the primary markets, like our platform. Further down the line, a few weeks, months, there'll be also, hopefully, secondary markets where all of you could, get exposure to those assets. Sure.
With the dividends from the companies, how do you treat that? If they're in the DeFi space, you don't know who's holding them. So how is the dividends distributed? Yep. Do you keep them? Are the tokens actually CFDs?
Yeah. So the question is about dividends. How do we pass dividends? Obviously, like sending value to unknown addresses is an AML fraud. So it's a no-go. We will not be able to do that. So the way we've solved that issue is that at first we're looking at we're tokenizing assets that either accumulate. So in the case of ETFs, they don't distribute, they accumulate. So basically, the yield is in the asset in the product, or it's growth stocks, and those stocks they don't pay a dividend. Now, if in the future, we could also like set up like a facility where you could do some like KYC to be able to get the dividend.
You wouldn't be able to trade them in the DeFi market from one user to another. So
you could still like trade it, like you could either like KYC with us and get the dividend, or actually like sell it on the secondary markets before dividend, and before it goes ex-div.
Who custodies the actual assets? As a company, do you custody them? And then that's where you can be able to redeem them?
So when you're talking about like custodying the assets, I assume you're talking about the underlyings that we actually purchase. We're not a regulated custodian, so how we do it, we actually have a commercial relationship with a bank that actually custodies those assets. One thing, I would like to emphasize again, like compared to cash, when you deposit cash at your bank, you actually lend money to a bank. That money is not yours anymore. If the bank goes bankrupt, you have to go in line in bankruptcy proceedings. When you hold securities, book entry securities, and it's being custodied by a bank, they're actually custodied in a segregated from the balance sheet. That's a lot safer. It removes counterparty risk. Yeah, so the question is when you hold the token, what do you actually hold? Like, what is it? So the reason why we registered the company in Switzerland was because of the DLT Act. The DLT Act, the Swiss, they basically, with the DLT Act, recognize tokens as a valid form of a security. So whether you hold a security in the form of a token or a banknote, it's the same thing for the Swiss. When you hold our token, you're a shareholder, like you own a piece of a structured product. And that structured product, without going into too many like details, it's a note which tracks the underlying, with the underlying being pledged as collateral to the token holder. So it's a very safe structure. It also involves a third party, a security agent, which is tasked to actually look at our balance sheet and make sure that there's no funny business. He has to, step in and actually take control of the custody account if he sees that, for example, assets are below liabilities. Yeah, please. So do we have any commodities? Do we offer commodities or precious metals? At the moment, no. Our first, the first 5 assets that we've tokenized were first like the S&P 500, Coinbase, New, a Chinese tech stock, and now 2 US Treasury bills and bonds ETF. But yeah, sure. The way we've structured the product is very scalable. And so we can tokenize potentially any book entry security. Right now, like shares, so like ETFs, we could tokenize definitely like commodity ETFs very easily. We don't really have an agenda as to like which asset we should tokenize. We're basically like listening to you guys, to the market, and wherever there's demand, we'll issue. Please.
What are the main benefits to like the end user of owning one of the tokenized ETFs versus just owning the ETF? How do you think about that?
Sure. So benefits of owning the token version of the ETF versus the ETF. I'd say if you have a bank account and you're able to hold the ETF, not so much at the moment. Like the added benefits are nil. But for crypto natives, DAOs, really like it's very difficult for these guys to actually hold these assets. So it makes sense. Further down, like in the future, when there's utility for these assets in DeFi, you could actually see people prefer holding the tokens because there's added utility with those tokens. You can lend them, you can earn a yield on them. Whereas right now in your Robinhood account, it's pretty tough. Like they won't give you that yield. Please. So I'm not sure I heard. Tax. Any difference on taxes? It depends on yourself, where you're based, which jurisdiction. So, for example, I'm a French national. In France, if you make profit and keep it in crypto, even if it's stable coins, you're not taxed on that. So potentially, like that's down to you, down to where you're. Not for shares, no. Yes, please. There is a withholding tax subject to treasuries in Switzerland. That's why we got a bit delayed on issuing our treasury product, and we're launching the product, and then we'll be basically moving it before the fiscal end year of the product to another jurisdiction. Right now, we're opening new issuers in a few different jurisdictions where there isn't such a problem with withholding tax. Cool. Thanks very much for making it entertaining.